Yes, sir. I can hear you, sir.
Okay, that's good. Okay, thank you very much. Okay, so I think we'll have to start now. We have waited for around 5 minutes for those that want to enter the class. This class starts 8:30. So good evening once again. You're welcome to Strategic Business Reporting class. And today we are going to be moving a step forward from where we stopped last week. I can remember vividly on Sunday, yeah, on Saturday, we looked at IFRS 2 on share-based payments, and the whole story, the entire principle around IFRS 2 was a situation whereby entity pays their employees with their shares or share option. And I just narrowed it to employee because that's the popular one you are going to find in your exam. It can be with other counterparty as well. But majorly, share-based payments questions would be between employer and an employee. So employer gives or promises to give shares to its employee. And we said in accounting for this, you will need to spread the entire arrangement. You need to spread the entire option over the vesting period because the employee would need to work for so many years before that employee gets that shares eventually. So we will usually recognize this option systematically every year over the vesting period. And the core principle there was that at the end of each reporting period, we will need to estimate the number of employees that will vest. And in determining the number of employees that will vest, we just need to have an idea of, okay, what's the total that will have left over the vesting period? So at the end of each year, we would usually estimate the number of people that will leave over the period so that we can have estimate of the people that will vest or people that will remain or people that will actually enjoy those options at the maturity date or at the exercise date. And it is that we would usually share over the vesting period, year in, year out, year in, year out, year in, year out. So that was the entire principle that we dealt with last week. So it's a very straightforward standard. It's just that for equity settled share-based payments, we also learned that there could be modification where we would have to increase in fact, not even increase, where we'll have to decrease the exercise price whenever the market price falls. And when they decrease that exercise price, it will usually result in an increase in the fair value of the share option. Now, when there is an increase in the fair value of the share option, it seriously means that the calculation of our option yearly would change because these options are usually valued at the fair value of the share option at the grant date. So when this happened, we said, okay, let's treat it separately. The original option price, let's continue to use it to value the option over the remaining period. While the increase, let's treat it separately. I just solved a single question to address that. And I said IPAN has not really tested this area, they can test it. We also look at cancellation under equity settled, where the employer decides to change its strategic direction towards compensation of employees, and they say that, okay, we don't want to give our shares anymore. Probably they want to just give outright cash. So they decide to cancel. And I told you that when there is cancellation, it's synonymous to acceleration of vesting, meaning that the entire on exercised option will vest immediately. And when it does, the company needs to know that, okay, this is the value of what we need to pay our employees. Immediately, they have cancelled. So they will usually compensate them. So we looked at how they compensated and how we use that compensation payment to cancel out the value of the equity reserves. And it ended there. In fact, the question we looked at, the value of the payment they made to the employees was even more than the value of the option. And we said that would be an additional expense to the company. Then we looked at cash settled share-based payments. And the difference between cash settled and equity settled is the fact that for cash settled, it's usually measured at the end of each year. It's usually measured based on the fair value of those, maybe share appreciation rights or whatever instrument that is issued at the end of each year. So, and again, because for cash settled, what the employer would give the employee ultimately is cash, though the cash is based on the share price of the entity. So, because of that, when there is an obligation to deliver cash, you would have a liability. So, unlike equity reserve, where we usually recognize, unlike equity settled share-based payment, where we usually recognize equity reserve, but for cash settled, we would usually recognize liability. That was the difference between it and that of equity settled. And that was really where we stopped last week. And I said there are two other parts of it that we are still going to come to. One of it is equity settled or cash settled, where either the buyer or the seller has a choice of whether the transaction should be settled in cash or in shares. And there is also deferred tax implication of share-based payments. So immediately said I'm going to address that. And the way it's going to work is that immediately I'm done with IAS 19. IAS 19 is a very straightforward standard. Immediately I'm done with it, we are going to be looking at financial instruments. That will be our next topic after this one. When I'm done with financial instruments, I will go back to that IFRS 2 and teach you that part of where there is a choice of settlements, because I needed you to understand compound financial instruments so that you are going to flow with that very well. And when I'm done with financial instruments, I might likely teach you IS 12 on income tax. Then that means you will learn deferred tax in that regard. Then I can then come back again to the deferred tax implication of share-based payments. Then I know that I've given you a complete package. Then we can then move to group account, consolidated account. That will take like almost 7 classes or 6 classes for us to round those up. There are a lot of principles to be learned also in that area. Then we come back to standards. Okay, so that was what we did last week. So we are moving according to plan. And I gave you some assignments. Um, yeah, for the record, none of you did it. So that goes to show that you haven't revised. That's not good. It's extremely bad, because that means you're going to be having a lot of things to revise now. And the way it works is that it's time moves very fast, and it will continue to be very fast. Before you know it, July is gone, August is gone, and I'll have taught you a lot. And as I'm teaching you a lot, for those of you that are doing more than one course, I know the other lecturers too are bombarding you left and right. So I mean, you really have to up your game and ensure you are really into what we are doing. You need a high level of discipline to be able to do well and pass at the first time. So go and review IFRS 2. I mean, even if you have not revised it as of now, that means you'll have forgotten most of the things I've said. The good thing is that there is the video there. You can always go and watch it, but do it as fast as possible. Do it as quickly as this week. Don't let it between tomorrow, next tomorrow. Make sure you revise IFRS 2 if you have not done so and solve those practice questions. Everything that is there, solve them. If you have any challenges, do let me know. Okay, so now tonight we are going to be starting up with IAS 19 on employee benefits. Again, looking at these standards, looking at this IAS 19 on employee benefits, the focus is around staff costs. Staff costs. And according to IAS 19, when it says employee benefits, it says they are all forms of consideration, all forms of consideration given by an employer to an employee for the services of the employee. You will see that from this definition, this is quite familiar with share-based payments, right? Just that share-based payment is exempted and excluded from IAS 19. Share-based payment too is a form of consideration given by an employer to an employee also. Just the IAS 19 now deals with other forms of consideration exclusive of share-based payments because IFRS 2 deals with that. Now, all forms of consideration. So, what are these forms of considerations or categories? Let me call it categories of employee benefits. You see, there is the short-term employee benefits. There is the post-employment benefits. There is the other long-term benefits. And there is the termination benefits. Okay, so we needed to look at these forms of benefits or categories because they are not treated the same way. And from their names, they also mean different things entirely. Like this short-term benefit, these are the consideration the employer gives to employees for their service in the short term. Okay, they are the consideration the employer gives to them every month, the consideration they give to them within the year. And this one works in such a way that as soon as the employee is working, the employer is paying, right? It might not be immediately, but I mean within 1 year of when they worked. Okay, so if the employee works in January, by the end of January, they will get the consideration. Worst case scenario, in the next 2, 3, 4, or 6 months, they get their consideration, but it must not exceed 1 year. Okay, so any form of consideration that an employee gets within 1 year, that anytime they work for that employer, they will get their money within 1 year. That is most likely a short-term employee benefit. So think of any of them. The popular one we know would be your wages and salaries and other allowances, right? Whether medical allowance, whether leave allowance, whatever. I mean, in as much as you get it within 1 year of when you worked, then that is a short-term employee benefit. Then there is the post-employment benefits. This is a retirement benefit. This one you get it after retirement. Now you must have worked all through your youthful life with the employer or for the employer. Then you would get it when you retire. Okay, so it's only when you retire that you can get these benefits. And I mean, the one that will come to mind would be gratuity or pension or maybe health insurance scheme that they give to you after you retire or any other benefits. It could be anything. Even if the employer says that they would pay your children's school fees after you retire, that's a post-employment benefit. Any benefit you get after you retire is a post-employment benefit. And there is the other long-term benefit. This one, you get them after 1 year. Now, if you work for it this year, before you get it, it will be after 1 year. It's not something they pay immediately. That's other long-term benefit. Okay. And the last one is termination benefits. This you get when either you, the employee, or the employer disagrees and they part ways. And there's a benefit one way or the other attached to that. That's termination benefit. Like when you guys part ways and probably maybe the employer is leaving the country as a result of maybe economic hardship or change in strategic direction. And it's okay, let's compensate our people that are here since they will be out of job for a while. That's termination benefits, right? So, which is most likely the case, right? Okay, so we need to really learn how to account for these four. I can tell you categorically that in the exams, in the past many years, I kind of focused on post-employment benefits. That has been their focus in like 5 years. Consistently, they ask it almost every day. So you find it in your exam, diet in, diet out is always there. I mean, you find it somewhere in the question. Okay, so if I may ask you, before I go to accounting for all of these categories of benefits, where where do you think the share-based payment I taught you for the employee, where do you think it will fall between these four? That's a question now. Where do you think it will fall? Who
Other
wants to try?
long-term benefits.
Thank you very much, Timile. Other long-term benefits. That is absolutely correct. Okay, so Former said, you joined today. Can I throw more light again? More light on what exactly? I mean, you're free to talk.
Sir, good evening, sir. Sorry, I just joined. I joined late, so I don't really know where we are now. That's what
Okay,
I mean.
like we should start over again, right?
Yeah, please. I know it's not okay,
Yeah,
but just please.
that's a very good idea. I haven't said much, lucky you. So, um, what I've said so far are just these categories of employee benefits. I mean, you might also be working somewhere and your employer gives you some form of consideration. And so we're just looking at those forms of consideration that you can have. We looked at short-term employee benefits, which is the one you get within 1 year, that as you are working, you're getting it. It might not be immediate, but at least you are sure that they will give you your money within 1 year. And the popular ones here are the your salaries and allowances or any other benefits, whatever it is that you can think of, whether medical allowance, whether HMO, whether whatever that they give you within 1 year. As soon as you're working, you will get it within 1 year. That's short-term employee benefit. Then there is the post-employment benefits, the one you get when you retire. So these benefits are paid to an employee when the employee retires, and the popular one that comes to mind is gratuity and pension. And also, there are other benefits that the employer that can give to its employee when they retire. So the key thing is, or the substance here is when the employee retires. And there is the other long-term benefits, which is the one you get after more than 1 year. That if you work for it this year, before you get the consideration, it takes more than 1 year before they pay it to you. And example of that is the share-based payment arrangement that we learned under IFRS 2, or they say that if you work I mean, they can say they will give you a car if you work for them for 5 years. Or there's some people that they usually celebrate people that have worked for 10 years and they give them certain amount of money. And it has not become a tradition that they give employees. Okay, then those are other long-term benefit because before you will get it is after 1 year. And there is the termination benefit, which occurs when either the employer or the employee decide to depart or leave one another. This one is before retirement. I mean, you could say you're leaving, or the employer says we don't want you anymore, then they give you a benefit for that. That's termination benefits. They terminated your employment and they say, okay, we are compensating you with this pending when you get a job, right? I mean, in some employment contract, you see it's that, okay, if you terminate your contract, we'll give you 3 months worth of salary. Those are termination benefits. And yeah, so that's basically what we want to look at today. So let's quickly pick them one by one because I want to see if we can be done with the explanations, then solve some questions today. Then next week, probably we'll just finish it immediately, then move to financial instrument on Saturday. But let's see how far we can go without unnecessary rush. So the first one, which is short-term employee benefits, this is extremely straightforward to account for, which explain why ICANN really does not ask it in the exam because in fact the basic examples are your salaries and wages, right? Salaries and wages, and these you usually get paid. You will get paid these benefits within 1 year. So, and in most cases, it's even monthly. If I want to use Nigeria as example, they usually pay you your wages. Most of your consideration, you get it monthly. While in some organizations, there are some they give them quarterly, there are some they give them semi-annually, like that. But the main thing is this. Let's say the one you are getting monthly. So if the consideration is paid monthly, if the consideration is paid every month, right? So at the end of the month, whether they have paid it or not, as soon as it is the end of the month, if you are the accountant, you need to recognize an expense as staff cost, then you need to recognize an accruals or an accrued staff cost at the end of every month, right? So let's say the amount is 100,000. Let's say the amount is 100,000. So at the end of every month, you recognize this if it's paid monthly. But how do you then net it off when it is eventually paid? Whenever it is paid, when it is eventually paid, you can tell me what will be the double entry you pass?
You debit the
Hello,
accrual
sir.
and credit bank.
Thank you very much. Thank you, Uma. You debit the accruals and you credit bank. Okay, good. So what if the consideration, let's say, so any consideration that is paid monthly is no more than this. This is how we do it. Okay. So if the consideration is paid, let's say quarterly, it's possible you have a quarterly consideration. So how do you account for this? How do you think you account for it? So let's say the consideration is 150K. So the way this can work is if the company prepares monthly reports, so at the end of each month, okay, you don't wait till the end of the quarter before you account for this. So at the end of each month, you probably debit staff costs and credit accruals with a portion of it, most likely maybe 50K if it's every quarter. So At the end of each month, you're doing this debit staff costs, credit accruals, debit staff costs, credit accruals, like that for the 3 months. Then when it is eventually paid, then you debit the accruals and credit bank to cancel out the payment. So this basically how short-term employee benefits works. So there's really no issue around this. Okay, so um the one that you need to pay close attention to is short-term paid absences. There are some short-term benefits that are paid to employee even when they are absent. And the popular one is leave allowance, right? Or even medical allowance. Um, leave allowance. Let me say sick leave or sick allowance, something like that. Okay, so let me just use these two. So when an employee goes on leave, of course, in our country, Nigeria, we would usually give leave allowance to that employee when they go on leave. So the bone of contention here is this. What if you don't go on that leave, right? Are you going to get that leave allowance or you won't get it? How does it work? Is there anybody that can help us? So there is leave allowance. You only get it when you go on leave. So what if you don't go on leave for that year? Do you still get it or you forfeit it? How does it work in your own company? Anybody?
You still
Hello, good
get
evening,
it
sir.
now.
Yes, now you still get it,
When
irrespective.
when do you get it?
You get it, for example, where I work, if you know that the particular time you intend to get it, anytime you apply for it, so long as you are qualified for that leave allowance. So for the year, so if you apply for or you intend to tell the management that you need the leave allowance by July or August, it will be given to you so long as you're qualified for it. Because as a matter of fact, it's even a benefit to the organization. They'll look at it from that angle that you're not even going physically. So
Hmm.
at least they should do that, they should pay you. So then some other people, they buy the leave too. If you not go, so it's like an extra benefit for not going. So the leave allowance stands as leave allowance. Then for not going, there could be a further computation to give an extra for not going. So it depends on the organization.
Oh, okay, I
We
see.
had those two experiences.
Okay, nice one. However, now it will be difficult for us to generalize in reporting because there will be some organization that will really need you to go. They will really need you to take some break and rest, right? And they will not compensate you for not going, right? So that they will do it in such a way that if you don't go, you will not have it, right? And so there would be some organization like that. So I think what Antonio have mentioned, that's how most organizations in Nigeria would operate. But a structured multinational, or most of these tech companies would really want you to take some break and encourage people to actually go. And they will do it in such a way that if you don't go, you won't get it. So because of that, right, IFRS IAS 19 then say that, you see, these short-term absences, because we don't know what the policy of the organization can be like. So they categorized it into two. Hmm? They say that, okay, we can have accumulating paid absences, short-term paid absences, and it's possible we can have non-accumulating paid absences. So the one that is accumulating paid absences, that's the one whereby the um that's one whereby if the employee does not go, you can actually carry it forward to next year. If you don't go this year, you can take it to next year that you are still is okay. If you're unable to go, carry it forward. We'll pay it next year. Okay. That's accumulating paid absences. But you see the non-accumulating paid absences, these are the ones that really want you to go, that they don't encourage you just coming to collect the money. So they do it in such a way that you don't go, is you can't accumulate it. You can't carry it forward. It's gone. That money is gone. We don't owe you. It's only when you go. So the organizations that use non-accumulating paid absence arrangements, they are the ones that really want you to go. That if you don't go, you will not get paid. So the way this then works is this. So let's assuming the leave allowance, let's say it's 5% of your basic salary. So let's assume um is 1.2 million, your leave allowance. Okay, let's assume it's 1.2 million. And this 1.2 million, you only get it when you go. So how do we account for this 1.2 million? If the employee does not go to the end of the year, he does not take it. How do you think we will account for this non-accumulating paid absence? Can anybody try? Non-accumulating. You only get the 1.2 million if you go on leave. So the guy did not go. So how would you account for this?
It becomes an income now to the company.
Mhm. Becomes an income to the company. Mhm. How about it doesn't even show in the books at all?
Hello, sir.
Hello, Anthony.
Yeah, what about if because it has been recognized initially as a staff cost and there's an accrual for it as well. So when the staff did not go eventually, the entry is reversed the other way around to negate it out from the books.
Okay, for non-accumulating paid absence, they don't recognize it. So it's usually recognized. This is recognized when the event occurs, meaning that when you take that leave, then they can easily recognize it. Because the danger of going to recognize this as staff costs, because what you will have done, like I've taught you before, is to say you want to debit staff costs and you want to credit accruals. So if the person does not actually take it, you now say you want to credit income. No, it's a wrong accounting. Since it's non-accumulating, you only get it when that event occurs. Okay, so let's wait for that event to occur. So the standard says that you only recognize non-accumulating paid absence when the event occurs. So if the leave is 1.2 million, if the event does not occur, that means it doesn't even show in our books as staff cost. It is not part of our staff cost for that year since it's highly conditional. But if it then shows, if the person takes the leave, then of course you would recognize it in our books at that point in time. So that's for this. But for this one, which is the one most you find most organization adopting, these accumulating paid absences, that they just want you to get it. Okay. So this one is the one you then accrue for, since you know the person will still get it, the accumulating paid absence. So usually is recognized either at the end of the year majorly. So if the employee does not take it at the end of the year, then for this one, you can easily debit staff costs and credit accruals for this accumulating, because you know that you are owing it. Whether the person takes it or not, you will still pay. You still get to pay. Okay. So you just get, okay, how much are we paying? So, but the reality is this. Do you know that for some people, even for this accumulating, right? So if the leave allowance, let's say if the leave allowance is 1.2 million, right? If you take it that year, okay, but if it's not taken that year, if it's not taken that year, the leave allowance that you're carrying forward becomes just 600K, meaning you can only get 50% of it. That's the contract, right? That the leave allowance is 1.2 million. But if you don't take it that year, that you say you want to carry it forward, they will tell you that you can only take half. So when you are recognizing it in your books, are you going to put 1.2 million or 600K for people that didn't take it for that year? What do you think?
Recognize 600,000, sir.
Okay, so which is what the standard said. So the standard says that for accumulating paid absence, okay, that they said any unused absences will be measured at the additional amount that will be incurred by the organization. Okay, so it might not be the actual amount that you guys have agreed before. There might be a policy that the amount will change. The amount will change. So in that wise, is the additional amount that you put in your books that you would that you're going to measure it at. Okay, so I mean, everything is still pretty straightforward around this area. So there is a question I want you to tinker with. Let me show you that question. Let me see if any of you can figure it out. So I'm sure you can still see my screen. So let's look at this question. Let's see if any of you can figure it out. So let's look at it closely. Please pay attention to it. I can call any of you to attend to it if I don't get any response. So it says Plyman Co. has 100 employees. Each is entitled to 5 working days of paid sick leave. Five working days of paid sick leave for each year. And unused sick leave can be carried forward for 1 year. Sick leave is taken on a LIFO basis, first out of the current year's entitlement and then out of any balance brought forward. As at 34 December 2008, the average unused entitlement is 2 days per employee. Plymanco expects, based on past experience, which is expected to continue, that 92 employees will take 5 days or less sick leave in 2009. The remaining 8 employees will take an average of 6.5 days each required. States the required accounting for unused sick leave as at 31st December 2008. Okay, so let me analyze this question for you. Just please pay attention. So this company has 100 employees. So they usually give 5 working days paid sick leave every year. And any unused sick leave, they can carry it forward. So that means this one is accumulating because they can carry it forward. And they say that sick leave is taken on a LIFO basis. That is, first out of the current year's entitlement, then out of any balance brought forward. So it means that if you don't take your leave in the current year and you then carry it forward to next year, so the policy of this company is that you first of all have to take the that next year's leave first before you can then say you want to take the one you are bringing forward from the previous year. Right? First out of the current year, then out of any balance brought forward. So you need to, anytime you're bringing forward leave from the previous year, you first of all take your leave for that current year first. Then you can then take the remaining. So that's how they work here. So at the end of the year, 2008, an average unused entitlement is 2 days per employee. So they are saying that for 2008, that on the average, each of our employee did not use 2 days this year, meaning that they are going to carry forward 2 days to next year, right? And don't forget, next year they are still going to have another 5. Okay, and the way it works is that they need to use that 5 first before they can use the 2 they are bringing from 28. But the focus is 2008 anyway. So there is 2 days unused leave per employee, and we have 100 employees. Now say that Plymouth, that this company expects based on past experience, which is expected to continue. Based on its past experience, which is expected to continue. That 92 employees will take 5 days leave or less sick leave in 2009. So they are now giving us an estimate that we expect that 92 employees will take all their 5 days leave next year. Then I said the remaining 8 will take 6.5 days next year in 2009. So they're now saying that how do you account for the unused sick leave in 2008? Okay. The key to this question is just to tell me that how many days of sick leave would this company have to pay for? Because they didn't give us how much they pay per day. That one is not a problem. You can always, that one is just a fixed figure. So that's not the difficult thing here. The difficult thing here is this. How many days of sick leave would the company be owing at the end of 2008? So I'm throwing it to you. How many days?
Sir,
Anthony. Okay, Olamide, go ahead, please.
the question does not expressly state how many days. Like this story now, it was written that 92 employees will take 5 days or less. Okay, less means how many days? It's not expressly stated, sir. So I'm trying to rack my brain, sir, but I can't figure out anything for now, sir.
No. You should be able to figure out because you are focusing on the on things you should not focus on. This one is very clear. 92 employees will take 5 days or less. Since they didn't specify or less, you assume they will take 5 days. So since it's an average, it's an estimate. So 92 employees will take 5 days. Clear. 8 employees will take 6.5 days. So I don't see anything that is not clear.
I would say 92 times 2 days. 92 employees times
Why
2 days.
why are you saying 92 employees times 2 days?
Because it's a normal, like the clause is based on past experience, which is expected to continue. So it's something that they forecast that is always occurring. So there are only 92 will take their leave out of the 100 employees. That's why.
But that's 2009 now. So how does that relate to 2008? Anthony, do you want to try?
Well, I think it has to be the 92 times 5 days. So I'm not missing anything here, but I just came in here. I'm just like I didn't even when you were reading, I didn't read it, but I'm just looking at it thoroughly. That it could be since I would have. It's supposed to be 92 times 5. So I don't know if I'm getting it.
No, you're not getting it.
So let me try.
Okay,
I think
please.
it's 200 days.
Okay, how did you get that?
They say the average unused is 2 days, and there is 100 employees. That is for at the end of 2018. So 100 times 2.
Okay, at least I have somebody that can say something that is even, that we can relate to. That, okay, oh, we have 2 unused sick leave, oh, and we have 100 employees, oh. So that means as far as 2008 is concerned, we have 200 days that we are owing people that we might have to pay for. Even though it is wrong, but at least that's more like it.
Can I try, sir?
Yes, please.
Okay, the way I'm looking at this, because if it says 92 employees will take 5 days and based on experience, so that means averagely 8 employees will not go for their leave, as in will not utilize the whole 5 days. So the 8 employees times hey, what am I saying? Sorry. Okay, the remaining days out of the 5 working days now, they've taken 6.5 days. Ah, God. Sorry, what I have in my head is then has gone out. I can't really think straight now.
Okay. I thought you were going to get it, but you did not.
Yeah, the remaining 2 days multiplied by 8, the remaining 8 employees, that's the outstanding for 2008. So that's the way I was actually going to analyze it to calculate for the unused sick leave in 2008. So that's what I was thinking.
Okay, but the explanation that is backing it up shows that you really don't get it. But you were close. Okay. I need one more person before I tell you the answer. Do we have Charity in this class? Is Charity in this class? Okay. She has refused to talk. So, 100 employees, 5 days each per annum. Each of them did not take 2 days each for 2008. If this question has stopped here, the guy that said 200 days will have been correct. If this question has stopped here, because we have 100 employees, each entitled to 5 days unused sick leave each. And they said each of them did not take 2 days for 2008. Okay. So they said as at 2008, the average unused entitlement is 2 days per employee. So we'll have been owing 200 days of sick leave. That will have been the answer. So if they had given us how much they pay per day, all you just need to do is to multiply by that 200 days by the number of or the amount they pay per day. So that's not even the focus. However, so they give us some estimates Because you know where this is coming from is that if in most organizations that do accumulating, if you don't take it this year, right, and you now carry it forward and you don't take it next year, you might forfeit it. Or if you don't take it this year, if you are taking it next year, you might not get all your money. So this guy is saying that in our company, based on experience, that we are estimating that in 2009, don't forget we are in 2008 December, they are just estimating, looking into the future, that in 2009, next year, 92 of these employees, 92 employees will take 5 days leave. Meaning that out of these 100 people, 92 will take their 5 days in 2009, which goes to show that they will forfeit their 2 days they are bringing forward from 2008. Don't forget that they told us in the question that sick leave is taken on a LIFO basis, meaning that whenever you carry forward your sick leave, you will need to take the current year first before you take the one you're bringing forward. So, and that's why they are giving us estimates that, okay, in 2009, 92 employees will only take their 5 days, meaning that they will forfeit the 2 days they carried forward to 2009. They will forfeit it. They now said that eight employees will take an average of 6.5 days. 8 employees will take 6.5 days. That's equivalent to 6.5 days, Abi. Let me put it as 6.5 days leave. Meaning that 8 employees will take 6.5 days next year, which means that these ones are going to forfeit just half day. Just half day, in the sense that these 8 employees will take their normal 5 days in 2009, and out of the two they carried forward from 2008, they will only use 1.5 days. That goes to show that based on this estimate that was given to us, as at the end of 2008, so as at 31st December 2008, our liability, the company's liability is simply 8 employees multiplied by the 1.5 days they will take, which is 12 days. That is, out of the 100 employees that did not use their 2 days leave for 2008, the question has told us that from our experience, 92 of them will not use it because they will only use the 5 days for 2009. They will not use the 2 days. So, I mean, if experience tells us they won't use it, that means we don't have liability for that. So accountants, we don't have to recognize that in your books as a liability because they will not use it, we will not pay it. And even the remaining 8, those ones, the question told us they will only use 6.5 days. So those 8 employees now, that 6.5 days translates to 5 days for 2009, that they will use 2009, and out of the 2 days they are bringing from 2008, they will only use 1.5 days, right? Which is the bone of contention. That 2 days that they are carrying forward, that's the bone of contention here. That means that 2 days, 8 employees are only going to use 1.5 days from it, and we are owing people only 12 days. That's our liability. So as soon as we get to know if this question has given us the rate per day, we'll just multiply this by whether it's 1,000 naira per day, whether it's 10,000 naira per day, whatever it is. That one is not difficult. The difficult thing is your ability to determine these 12 days. And that's it. So I thought somebody would have been able to figure it out, but none of you could. Hopefully you'll be able to do better next time. Anyone that didn't understand it, let's hear you out. Is there anybody that didn't get it so that we can discuss it further?
Hello, sir.
Yeah, Uma.
Sir, but that is the question. It says state the required accounting or usual sick leave. Is it talking about the days or how to account for it?
You already know the accounting for it now. It's just to debit the staff costs and credit accruals. Okay, so that's not the difficult thing there, which is why I've already mentioned that over and over again. The accounting is never more than this. So it's how to get the amount that I took my time to explain, which is difficult in there. And I've told you that they didn't even give us the rate per day. That's not the focus of this. I was just the one that put this one there myself. So the focus of this question is how many days are we owing? So that is what I need you to know that you understand first. If you understand that, then the accounting and the amount is not difficult to get. That's the easiest thing. Hello?
Hello, sir. Yeah, is it when figures are being added to that we will consider that 50%, right?
Which 50% is that?
That if you carry forward your leave, you cannot carry it 100% to be 50%. That you give out the example
No,
of 1.5 million.
it depends on the question. They can structure the question in different ways. The one I told you, I was just using that as an example, that if that's the situation, right? So it depends on how the
Yeah.
question is actually structured or how the policy of the organization is, right?
Okay, okay.
So for these ones, this particular one that we looked at, you can actually carry it forward. You can carry it forward, but when you carry it forward, you have to use the current year first before you can use the one you're bringing forward from the previous year. So, and ultimately from this question, we saw that our employees used only 2 days. Sorry, our employees did not use 2 days in 2008. And the question told us that next year, 8 of them will only take 1.5 days out of it because they will take on an average of 6.5 days next year, which means that this 6.5 days means that they will take their 5 days from 2009 and they will take only 1.5 days from 2008, the one they are bringing forward, because sick leave is taken on a LIFO basis. They will take the current year before they take the one of that they're actually bringing forward. But the other 92 they are not even going to use it because they're only going to use their normal 5 days. So based on this estimate they have given us. So as far as 2008 is concerned, the only liability we have is on these 8 employees that will take 1.5 days out of their 2 days. So the liability will accrue for is just for 12 days. The liability will accrue for is just for 12 days. Okay.
Yes, sir.
Now, that is short-term employee benefits. There could be profit share or bonus as well as a short-term employee benefits also. But this one, you can only recognize it if we are sure that the company is going to pay that bonus or give that profit share to an employee. The management of that company must have announced to the employees that, okay, we are declaring bonus. Or probably maybe there is a predetermined amount or target that the company must meet, that as soon as the company meets that target, they would everybody knows that they will get bonus. So let's say they would say that if we're able to achieve 10 million profits this year, we'll give bonus to all our employees. So as soon as the company meets that target, you as the accountant, you should know that you will need to account, your company already owes bonus to everybody. So at any point in time, you can easily debit staff costs. The accounting doesn't pass this for short-term employee benefit. It's just at what point do we owe? That's the major question now. So for this one is when is reasonably certain that the company cannot avoid this liability. They have made an announcement that, okay, oh, everybody, we are sharing profit this year, or the company has met their profit target for the year that will qualify everybody for bonus. Then, of course, they can go ahead and recognize it in the books. Okay, so that's for profit share or bonus. Okay, so let's move to the second categories of them. So we are done with this. It's not common in your exam. I've not seen it in your questions. So even if they want to ask it in the exam, it might not be all of this because the examiner knows that the accounting is just this staff cost accrual, staff cost, just accrue for it. As soon as the employee has worked for it, accrue for it. So the only technical one there, which I don't even ask, is this example I gave you concerning paid absences that some of you are finding difficult to grapple with. I don't know why. So, except that, the others are very straightforward. So, again, the one they usually ask in your exam is this second category of employee benefits, which is the post-employment benefits. So, we find this one commonly in the exam. Now, you see, this one is the benefits payable to employee when they retire. Okay, so the key thing is here is this. For the employer, which is the person we are representing now, the company you would be working for. So how do we recognize this? How do you recognize and measure this in your books? So since you say that this person, we're going to pay him so much when he retires. So when should we recognize these amounts we want to pay him as staff costs in our books? Are we even going to recognize it at all? Or how should we do it? Now, there's a lot of things attached to that in terms of how much you recognize in your books, either every month or every year. Okay? It's either because, when the person retires, how much do you want to pay the person and all of that? So is the way it works is this. Company usually plan for these benefits because it's usually a lot of money and it's not trivial at all. So company usually enter into plans. And these plans, IAS 19 says that it could either be a defined contribution plan or a defined benefit plan. Defined contribution plan, defined benefit plan. What defined contribution plan means is that your employer or companies or entities would register with some government recognized institution which we call PFAs. Like there's the Stanbic IPTC PFA. There are a lot of them, all these pension fund administrator. Employers will usually register with them, and they will be making regular contribution to those PFA. So And the agreement with the PFA is that when our employee retire, please give them their money. Please give them their money. And it ends there. So what the employer does is just to make regular contribution. And they do nothing beyond that. And it is backed up by Nigerian law. There's the Pension Reform Act of 2014 that strongly backs this up. That employer, make sure you make regular contribution. And that's it. That's the only obligation that the employer has, just to make regular contribution, which goes to show that if the PFA loses that money, the employer is less concerned. The employee cannot go back to the employer and that, this contribution you have been making for me, where is the money? Because the reality is this: the way the Nigerian law works is that the employer removes certain percentage from your money. They will also add another percentage that they make contribution of a total of 18% of your total emolument to those people. So they have been taking your money every month and giving it to some set of people. If those people squander the money, it's gone. But good enough, they haven't so far. So your money to a large extent is safe. So, but the major thing here for defined contribution plan is that the employer only makes contribution. That's the only obligation they have, make contribution. That means that to account for this is extremely straightforward. In Nigeria, you're supposed to make that contribution at the end of every month. So at the end of every month, as part of your personnel cost or staff costs, is that they call it staff cost or pension expense, whatever, they credit accruals. And that's the accounting for it. And it's possible that they can overpay. It's possible that becomes a prepayment for the company. But accounting for this is just this straightforward. Then when they make that payment, you then cancel out the accruals and credit back. For defined contribution plan, the only obligation the employer has is just to make regular contribution. It is now left to the PFA to settle you. For the defined benefit plan, under this kind of plan, the employer has promised the employee amount of benefits when they retire. The employer has promised the employee an amount of benefits when they retire. The simplest form of this one is that you started working with an organization and they say that when you retire, we are assuring you of 50 million benefits. Or they say when you retire, we are guaranteeing you that your final salary, let's say your final salary per month was 2 million per month. That after your retirement, we will ensure that you continue to get that 2 million naira per month. So the substance here is that they have promised an amount of benefit to the employer, whether in cash or in kind, whatever it is. They have promised an amount of benefit. For defined contribution plan, the employer is not making any commitments, no risk. It's just for them to make contribution. But for this one, they have huge risk, both investment risk and even estimation risk that we call actuarial risk.
Excuse me,
Everything is there.
excuse me, sir.
Sorry?
Please, I have a
Yeah, I'm listening.
question. I have a question, sir, please. Under
Please ask.
the defined contribution plan, I know you were saying just now that the employer does not make any commitments under the defined contribution
Yes.
plan, because I know that
Yeah.
for the PFAs under the contribution pension scheme, the employer normally contributes 10%, the employee will contribute 8%. Is that not also a benefit from the employer?
Yes, now that's what I've mentioned now, that the only obligation they have is the contribution
Okay,
that they are making.
okay,
That's the only obligation they have. Anything beyond that is whatever happens to the money afterward is none of their, is less, it doesn't concern them,
okay, okay.
because all
Thank you.
they do is just to make regular contribution.
Okay.
Okay, so before I go deep into this defined benefit plan, let me show you something. There was a question they asked some diet ago. Let me see if I can pick it up. Okay. I noticed that you guys are always sharper on Saturday than in the evening on Wednesday. There are some questions I will ask you that you give me beautiful response on Saturday, but on Wednesday, I don't know. It's always a struggle.
Stress.
Yeah, maybe. I mean, to be okay. Let me show you this past question. I just want to be showing you how ICANN is asking it on the go immediately, so that even that IFRS 2, is there any one of you that have checked that last diet question? Okay, let me not waste your time. I know nobody did so, but just go and check that last diet IFRS 2 question. So let's look at this question together. It says that Dovetail Nigeria Limited is into production of cashew nuts for global consumption. The entity has 3,000 employees on the payroll who are qualified for approved defined contribution plan being operated. The company makes annual pension contribution of 28,000 per employee. In 2016, the company made a total contribution amounting to 150 million, as well as 119 million and 54 million in 2017 and 2018, respectively. Required in accordance with IAS 19, how should the pension contribution be treated and accounted for in the financial statement of the company for 10 marks? Okay, so this one is clearly a defined contribution plan, because the question told us so, right? That the company operates a defined contribution plan, and the entity has 3,000 employees on their payroll. So they said the company makes annual contribution of 28,000 per employee. 28,000 per employee. So they say in 2016 they contributed 150, 119, like that. Okay, so the thing here is this. For this, the expense for them every year, okay, let me say the pension expense every year, the pension expense per annum should be how much? Should be 28,000 times 3,000, because they told us that they pay annual pension of 28,000 per employee annual. And since they have 3,000 employees, so that means every year they are expected to contribute how much? Can you quickly press your calculator for me, please?
84,000.
Sorry?
84 million. 84 million.
84 million. Okay. Let's say 84 million. So ordinarily, every year, they should just do debit staff costs and credit accruals with how much? 84 million. This is what should happen every year. But looking at it, in 2016, I know that their staff costs, or let me call it pension costs, I know it should be 84 million. I know it should be 84 million. But how much did they pay in 2016? How much was the pension paid?
150.
They paid 150. So there's a difference of how much?
66.
What do you call that 66? That's a prepayment. To be an asset, that's a prepayment. It's an asset. So in 2017 now, I can say, let's say balance brought forward, since an asset, that 66, they can bring it forward as an overpayment. In 2017 also, their pension costs, their expense should simply be still that 84. Should still be that 84.
Yeah.
But how much did they pay?
119.
They paid 119. So let's assume this is in jackets. These jackets, expense paid jackets. Let's say this is in jackets. So they paid jackets. So what will be the balance here?
35.
Which is 84 minus what?
119.
119. 119. So what about the one they are bringing forward?
Yeah.
Are you going to add to it or remove it?
You add to it.
Add.
You remove.
Okay, let's look at it at the very simplest form ever. You are supposed to pay 84. You paid 150. So you have overpaid 66 in 2016. You overpaid 66. So there's a 66 overpayment from last year. This year again, you are supposed to pay 84. You now overpay again by 35, you said.
Yes.
So that means you have overpaid by 35 this year, in addition to the overpayment of last year of 66. So what's
66.
the total overpayment now?
99.
Good. So it can be that, your analysis can be that simple, just so that you will not get it wrong. You see that, no, I'm not doing debit and credit. I'm not doing anything out of the ordinary here. If you can do this analysis in the exam, 10 marks. In 2018, there is an overpayment of 99, which in accounting we call prepayment. How much is it supposed to pay every year? 84.
84.
How much did it pay in 2018?
50. 54.
You only paid 54. You only paid 54. So what's the balance?
30.
There's 30. Okay. What happens to this 99? What does it do to that 30?
It will reduce to 69.
Thank you very much. 69. And that's the end of this question. So, since the question says that in accordance with IAS 19, how should the pension contribution be treated and accounted for in the financial statement? So, after you have done this schedule, you will need to prepare a financial statement. You prepare a statement of profit or loss for 2016, 2017, and 2018. You can have pension expense 84, 84, 84. And in the statement of financial position in 2016, 2017, and 2018, you can have repayments 66, 99, 69. 10 marks. 10 free marks. Any questions?
Please, that 99, I don't know how you come back to get that 99.
Oh, okay. Let me explain it again. So the pension expense is 84. You know we got this 84 from here now. 84. In 2016, he paid 150, meaning he overpaid by 66.
Okay.
In 2016, there's an overpayment of, so prepayment is an asset, we carry it forward, 66. In 2017 again, every year is supposed to pay the 4 million pension. Again, they told us in the question that this guy paid 119 again, meaning he's supposed to pay 84. He paid 119, so he also overpaid again by 35. So what's 35 plus 66?
101. 101.
101.
101. It is not
That's why I'm
99.
Oh, 101.
It's not 99, sir.
Husseini.
That's why I was confused
101.
over it.
101.
That one should be
So
71.
how much would this give us? This
Let me
71.
check. Because I saw some more questions from yes.
Okay. So the key thing, see, what this question demonstrates is defined contribution plan is very straightforward. It's still the same principle. It's very similar to short-term employee benefits. The double entry is no more than this. As soon as it's due for payment, you debit staff costs or specifically pension expense, you credit accruals. And then this question even showed us that it's possible for the company to overpay. Then that becomes a prepayment. And prepayment is an asset. It shows in the statement of financial position, as you have seen here. So we can carry it forward and continue to capture the pattern of their payments. Then we recognize it as necessary. So this question is good, exposes you to just, these are still elementary accounting that you should be able to conveniently do in the exam to get 10 marks like that. Okay, so is this all clear to everybody? Okay, so let me use the next few minutes to quickly explain. So that means I'm done with defined contribution plan. So let me go deeper into defined benefits plan. So I already told you that under defined benefit plan, the employer has promised an amount of benefits to the employee when they retire. So the employer has made commitment that when you retire, you will get so much. Or when you retire, we will give you a brand new car. When you retire, we will pay your children's school fees. When you retire, we would ensure that the return on the investment you have been keeping for you will be at least 7%. When you retire, we would ensure that you continue to get your final salary as pension, something like that. Anything where the employer is making such commitment of payment to the employee when they retire, that's a defined benefit plan. It's different from defined contribution that all they have not made any such future commitment. So here too, a lot of things will have to then go behind, in the sense that the first thing the employer will have to grapple with is that how much are we going to be contributing every month to ensure that we meet up to that amount that we have promised to the employee. Unlike defined contribution plan, they don't need to think at all, because Nigerian law already says 8% from employee, 10% from employer. But for this one, that 8-10% might not be sufficient. They would need to scientifically work it out. Accountants are not trained to do that. There is no standard that teaches us how to do that. There are professionals that do that. We call them actuary. So just give them how much. Just tell them what you want to do for those employees, whether cash or kind. In fact, the first challenge is to determine the monetary amount of that future benefit at retirement. That's the first challenge that accountant cannot do. We cannot do this, especially if it's something like, okay, when you retire, we'll give you a brand new house. When you retire, we'll pay your children's school fees. Or something like that. It's only if they mention an amount that can be easy for us, but something where you have to do valuations, do a lot of things like that. And it's not like they are making that promise to one employee, plenty employees. So a lot of things will go into this, because some employee might even die before retirement. Some might leave. A lot of changes, and they will attach. So we are not trained to do this. Actually, we do all of those headaches and those calculations. So, and those people that do it, we call them actuaries. Those that study, those that usually study actuarial science in school. So they do all these calculations of financial asset and all that. So this actuary, they are experts in making actuarial assumptions. They are experts in making actuarial assumptions. And in a situation like this, they are the one that will help us determine how much is the monetary amount of this future benefit. They will also tell us the contribution you will have to be making every month to ensure that when these guys retire, you can meet up. You will do all of those estimations for us. So, but I'll just tell you the way it works in practice, which is, of course, how the examiner usually model it in your exam, is this. So, most companies, when we go out for audit, we usually find that most companies don't use defined benefit plan. Very few companies use it. And when they do, they don't account for it rightly. So when we get to the field, the first thing we ask them or demand from them is an actuarial report. So we request for an actuarial report, because they don't possibly expect me, the auditor, to be doing all of this. I will do rubbish. I'm not trained to do that. I'm not an expert in that. So if they don't have one, they will have to go and hire an actuary that would come up with this actuarial report. And what I'm looking for in the actuarial report is number one, which is what the examiner will ask you in the exam. Not how to determine all of this, no. Not how to make this assumption, whether demographic or financial assumptions, no. The examiner might want to be sure that you understand what we mean by actuarial assumptions, which is the assumptions the actuary makes in terms of the amount of benefits that will be paid in the future, how much contributions, the changes that can happen to the organization, whether some employees will retire, whether there will be salary increase, whether some people will die, something like that. But the first thing the standard requires me to ensure the actuary puts in place, number one, is that the use of what we call projected unit credit method. The use of projected unit credit method approach to determine most of those figures. So the idea behind projected unit credit method, from the name, the standard is recommending that they need to annualize their figures. They need to annualize the figure they are giving me. The actuary cannot come up and say, and be giving me that, okay, this is the total contribution you must make over the lifetime of this employee. This is the benefit. You need to tell me what happens yearly. You need to break everything down into year by year, because accounting is year by year. So I need to know how much I'm putting in my books every year. So the standard recommended a unit approach. So the actuary must do it in such a way that every year an employee works for an organization, he must attach a unit. He must use that as his basis. He will attach a unit to each year the employee works with the organization. And that's how he goes ahead and determine all of its figures on a credit unit basis, year by year. That's projected unit credit method. Attach units to each year. Give me all the figures you want to give me per year. That's the first thing you need to understand, that you need to emphasize on as an auditor or as an accounting personnel. The use of projected unit credit method. The second one is that when they come up with their reports, these are the figures you should be looking for in that report. Number one is, we call it current service cost. And this current service cost is similar to the annual pension expense. Annual pension expense is similar to that. That, okay, this employee has worked for this year. This is his pension expense. This is your cost for the year. This is the company's cost for this year. That's why they call it current service cost. That's okay. Every year the employee works, this is your expense for that year. This is the company's expense for that year. And you can guess what the double entry will look like. That means you will debit P or L. Call it current service cost. Because it's not like they are paying this yet. So it becomes the credit is a liability to the company, and that liability we call it present value. Let me write it in full for you. Present value of defined benefits obligation. Present value of defined benefit obligation. This is the double entry for this. Current service costs. For every year the employee works, so the actuary would calculate the amount of pension expense the employee is due to in such a way that if the employee decides to leave that year, that means the employee is due to this one alone for that year. So we debit P&L, we call it current service cost, and we'll credit PV of defined benefit obligation. And this liability that they call PV of defined benefit obligation, it goes to show that the actuary will have used some form of discounting, because since this amount will be paid much later into the future, is something that we are saying it should be payable at retirement. Even in Nigeria, when contributions you make to PFA, you cannot break it until probably maybe you're 50 or maybe you're out of job. Then you can apply for 25%. And even when you apply for it once, you cannot go back and say you want to collect another 25% that you have lost your job again. No, you only get it once. Any other one you get is when you're 50 years old or when you retire. So it's something they pay in the future. So, but for us, we need to recognize it in our book now. And the only reason we are bothering about this is the fact that we have gone to make a future commitment. We have told the employee that we are going to pay you in the future this so much amount. That's why we need to keep track of it. And that's why we are battling with all of these, debit this, and we have to credit a liability, defined benefit obligation. Now, after dying, the third thing you will find in the actuarial report is contributions. So the actuary will tell you the contribution you then need to make either monthly or annually. The pension contribution you need to make. Now, you know that if let's say this is 100 million that the actuary gives you, you know that one will expect that then one will expect that you should make a contribution of 100 million too, right? Since this current service cost is saying that, okay, this is our expense, this guy has worked this year, this is what he is entitled to, then one would think that then that's how much they should contribute, but that would be wrong. This 100 million this 100 million the guy will have given you here is the present value of what you will pay when the guy retires. Is the present value of what you would is not something you are paying now, something you pay in the future. So this 100 million will have been present value. So this contribution, the guy will have worked it in such a way that this will be like the future amount. This might be like 150 million. But how they determine the figure, seriously, is none of our own business as accountants. Seriously. So don't really bother yourself about that. All you just need to know is how to account for it. That's what accountants do. So again, for contributions, whatever the amount they have given you, you are going to contribute into a plan asset. Then, of course, you credit bank. And when I say you are contributing into a plan asset, it could be maybe you can choose a PFA, right? But because it's compulsory in Nigeria, that you contribute to a PFA. So, and in addition to that 18%, there could be some voluntary contribution. So, I mean, just for those that are using defined benefit plan, so that 18% is not all and all. You could contribute more. It could be an insurance plan. This plan asset could be an insurance plan. There are some mutual fund you can invest to, where they will tell you contribute to some amount every month for 50 years, whatever. It could be stocks. They could invest, the plan assets could be stocks. It could even be real estate investments. Could be real estate investments. Could be any of these that they are contributing this money into. But what is important is that the standard calls it a plan asset. So they contribute into a plan asset. Then, aside from this contribution, you can also find something we call past service costs in the actuarial report. And this past service costs is a change in the obligation. Let me write it in full. In the PV of defined benefits obligation. A change in the present value. Remember where I mentioned present value? So it can change maybe after 5 years or after 6 years. Imagine recognizing 100 million every year. Maybe after 5 or 6 years, they now say that it changed, not because you contributed so much or anything. So if there is a change in the PV of a defined benefit obligation as a result of an amendment or a curtailment, that's what we call past service cost. You see, an amendment is an introduction of a new plan or scheme. It's just like your employer just came after like 6 years and say, "Whoa, I'm impressed with every one of you. You have done so well for the past 6 years. And because of that, we are adding a new line of benefits for you guys. We are going to be ensuring that everybody gets a brand new house when you retire." That's an amendment. They are introducing a new plan. They are introducing a new scheme. Everything changes. So that change, it is going to, that means the obligation they have would expand. It would increase. If the obligation was 500 million before, it can become 700 million. So that's an amendment. Okay? Amendment is bringing up a change. So that change is what we call past service costs. Past service costs. But a curtailment is let me call it the cancellation of an existing plan. So it's like the opposite of amendment. This one is saying, "Oh, we have done so badly. We are not doing so well. So you see that plan that we said we were doing before, we have to cancel it." Something like that. You see that house we say we want to give everybody when you retire, we cannot afford it anymore. Something like that. That's a curtailment. So they are canceling an existing plan. So their obligation, of course, would reduce because, I mean, they will be owing people much lesser. So that decrease also can also be a past service cost. So past service cost, the double entry is also that change goes to P&L, call it past service cost, and they will credit PV of defined benefits obligation, PV of defined benefit obligation, and this will be a case of an
Yeah,
amendment.
sorry. Sorry, let me ask this question. How do you credit P or L?
Sorry, do you mean credit or do you mean debit? I say you debit P&L.
Oh, sorry. How do you debit P or L? I don't understand the statement.
Expense now is an expense. Hello, Informer.
Understood, sir. Yeah, understood.
Okay. But it could be the other way around when you're debiting defined benefits obligation and you're crediting POL with past service costs. So this is in the case of curtailment. So in this case, there will be a decrease in that obligation. The next one, which is number 5, is benefits paid. Let's say people start retiring. Somebody retired and you need to pay that person. You need to settle up that person. So I think this one is very straightforward. Is there anybody that can attempt this one from all the one I've told you so far? If somebody retires and you need to settle up that person, what do you think will be the double entry?
You debit the expense and credit bank the benefits expense.
No.
Debit
So,
across a credit bank.
sorry, again, what do you say?
Says debit across a credit bank.
Okay, if you are debiting accruals, meaning you want to cancel out accruals, meaning that you must have credited accruals before. But have we credited accrual in everything I've said here so far? No. So
Okay.
you're not debiting accruals. So the benefit paid, one, this benefit is not like you are looking for the money now. So there's the issue of crediting bank will not come up. And in fact, you are not even the one that will pay it because you will have been you have been contributing into a plan asset for a very long time. So it's just a matter of instructing that plan asset or the custodian of that plan asset that please pay this person. So what you just need to do is that your obligation, this obligation that you have been accruing, this obligation, whether from current service cost or past service costs, that has been accumulating over the years, eventually reduces by debiting PV of defined benefit obligation. You debit it to reduce it. And please, if you don't know debit credit, of course, all of you should know debit credit. You're accountants. But I mean, for this exam, if you don't know debit credit, just understand that when liability is decreasing, we usually debit. So if you don't like these debits, whatever, you can say decreases. Decrease. It is more than enough for you. Just understand the substance of what we are talking about. So when you pay benefit, it means that your obligation decreases. Okay? Your asset too will decrease. So you credit plan assets because you are actually going to be paying these benefits from the plan asset. So this is how this works. This is how benefit paid would work. Your liability decreases, your plan assets decreases. Number 6 is gain or loss on settlements. So this is only arising or can only arise where there is a curtailment. So this can only arise where there is, I've mentioned curtailment before, which is where there is a cancellation of an existing plan. You see, where an employer says, I'm not doing again, it's as a result of a lot of things. And the popular one is maybe the company is shutting down. The company is going out of operations. Okay. So, and they say they want to cancel this plan, curtailment. So when they do that, there is always settlement that will follow. All those obligations, everything will have to, they will need to cancel out everything. The plan assets, they will need to net off everything. So these arise where there is a curtailment. So when there is a curtailment, then they will need to settle. Now, and we are talking about a situation whereby they are settling at the settlement price. And this settlement price, don't forget, is equivalent to whatever it is in their plan assets. Let's say their plan asset is 50 million. Okay. And they need to cancel it out against the obligation. So let's say their obligation is 55 million. Now, ordinarily, they should settle it with 55 million. But most of the time, you find out that they will not settle with 55 million. They will find a way to negotiate. And they will find a way to negotiate to, let's say, 50, like I've mentioned. So in this case now, the company has actually made a gain on settlements that they will take to P&L of 5 million. So it's usually straightforward. All of these details they will give you in the exam. It's just for you to know these terms, for you to just get used to it. So the examiner would tell you everything. The way I'm explaining it to you is how they would present it in the exam. They will tell you that, oh, this company says they are not doing again, they want to cancel, and on this their benefits plan, they have an obligation of 55 million, and they have negotiated to settle it with 50 million. And that's all they will say. So it is now left for you to know that what you take into your books is the gain or loss on settlement that you get, that you are going to take to P&L. Okay. And of course, your plan assets decreases, your obligation decreases by 55 million. So automatically, if the employees agreed to get 50 million for 55 million, I mean, as far as the employer is concerned, they have actually made a gain. I've actually made a gain. Okay, so substantially, this is like 90% of defined benefits plan. It's not difficult, just that you're just hearing some new things that you just need to get used to just by sitting down and thinking over what I've mentioned in this class. From the fact that, I mean, you have made it easy to the point that it's an actuary that gives us all of these figures. So headache around how they're supposed to compute it, that one is not our own business. What I need you to know for your exams is just to know how to account for each of these items, which the examiner will give to you in the exam from current service costs. Know that it goes to P&L and it increases your defined benefit obligation. Contributions, know that it increases your plan asset, and this is what you actually pay. So this asset, past service costs, know that is a change in obligation, either from amendment or curtailment, benefit paid, gain or loss on settlements. That is it that you need to know. That is that you need to know. Okay, so now how do we then present all of these figures in our account? How do you use it to prepare accounts? So let me show you that before we go for tonight. Ufoma, you're raising up your hand. You want to ask a question?
Yes, sir. So this actuary is just hearing it. Can you who are they? Are they a professional that they value employee benefits or
Yes, sir. Yeah, there are those people that study actuarial science in school. So they will have trained them about a lot of valuations, making assumptions about future amounts. They are experts in doing financial asset valuations. You know, we have estate valuers. They are estate valuers. Those ones are experts in valuation of physical assets. You want to value your building now. Those ones are good with that. They can go to the market and look at how much it is. So there are some people that are specializes in this, um, making future estimates, doing discounting, doing all of that. Those ones are actuary. So those that study actuarial science in school are those that specializes in this part of valuation. And we use them as auditors and accountants.
okay, sir, thank you. So
You're
please
welcome.
scroll to the bottom. Let me copy the last. Okay, there. Thank you.
Okay, now before we leave, let me put everything together for you. Let me put everything together for you. So, are you finished copying, Ufoma?
Yes, sir. Yes, sir. Thank you.
Okay, so let me put everything together in one place. So, you see, ultimately, everything I've mentioned, they will all end up either in the plan assets or PV of DBO. When I say PV of DBO, I mean present value of defined benefit obligation. Okay? And there's something we call net here. So let me put naira sign, because they are assets and obligation. So there is always balance go forward and the net. So the net is just the difference between the two. We'll give you the net. So you see in the exam, this table I want to show you is something you would always do. All the questions I will solve for you in this class on this topic, we would always use this table for defined benefit plan. So the first thing you must always do is to calculate interest. So the examiner would usually give you an interest rate, maybe 10%, whatever it is. So which is just to calculate this interest on these opening values. So for plan assets, you calculate the interest. For this one, you calculate the interest, and you get the net, which is the difference between the two. And the reason you are calculating interest is the fact that both this plan assets and this PV of defined benefit obligation, they are usually determined by discounting. The actuary does discounting in determining them. So, and us accountants, when they give us discounted figure, you would usually unwind the discount at the end of every year. So you would unwind the discount. Unwinding is that you are releasing that discounting since you are moving into the future. You want the amount to keep increasing over and over so that when you get to that point in the future, the amount should have become that future amount. So whenever we do discounting, at the end of every year, would usually unwind that discount, which is exactly what they are doing here. Okay, aside this one that you need to always remember to do, the first thing I mentioned for you was current service costs. And I told you that one you debit P&L and you credit PV of DBO. So it's something you add to your PV of present value of defined benefit obligation. I also mentioned contribution, and I said this one you debit plan asset and you credit bank. So it's something you add to your plan assets. Okay. I also mentioned past service costs. So this one also debit P&L, credit PV of DBO. So it depends. It could be increase, it could be decrease. Depends. And I then mentioned benefits paid. This one, you take it out from the plan assets. You take it out from the obligation. Take it out from the plan assets. You take it out from the obligation. And also, you would have, I mentioned gain or loss on settlements. So this one also, since you are settling, you take it out from plan assets, you take it out from obligation, then the net could either be a gain or a loss that you eventually take to P&L. So this is everything. So when you would always have to do this table. So when you do this table, let me call the balance, let me call it carrying amounts or balance carried forward, whatever you get. You'll find out that the examiner will now give you fair value of this amount at the year end. They will give you fair value of this amount at the year end. So they will give you fair value of the plan assets. They will give you fair value of the DBO. You get the net. You see, the difference between the fair value of the plan assets and the fair value of the carrying amounts, we call the difference return on plan assets. And you take it to other comprehensive income. Okay, you take it to income. So if, for example, the fair value is 1,000 and your book value was 800, that's good. That means the value at the end of the year or the fair value is much higher than your book value of your assets. But for obligation, the difference between obligation, fair value of obligation, and book value of obligation, we call that actuarial gain or loss, which also go to OCI. And the scenario is this: if the fair value of your obligation, let's say the fair value of your obligation is 200, they always give you this. And based on your table, let's say the book value is 220. You know, this is a gain. This is an actuarial gain because it's like your obligation reduced. Because from your books, your book is saying that your obligation is 220. But when the actuary came up with the fair value, with his own fair value, he came with a lower figure saying that you don't owe 220. What you owe is 200. That's good news. That's a gain. So we call that an actuarial gain. So these are things you would need to, we are still going to really deal with, that the examiner needs you to know to get the difference between all of this. So this is the table you must do first. Now, when you do this table, you will then use this table to prepare your statement of profit or loss. And what goes to your P&L first is the net interest. Net interest, this one, what you pick is the net. I will show you when we solve questions, so you will see. Second is the current service costs. Current service costs, because if they are expense, let's put them in brackets. This net interest will either be net interest expense or net interest income, depend. If the interest for the plan asset is higher than that of the obligation, that will be a net interest income. But if the interest on the obligation is higher than the interest on the plan assets, that will be a net interest expense. Also, what goes to P&L is past service costs. That also go to your P&L. Also is your gain or loss on settlement. So if it's a loss, if it's a gain, so these are what goes to your P or L. Then in the statement of other comprehensive income, you have your return on plan assets, and you also have your actual loss or gain that goes to your statement of comprehensive income. Then in your statement of financial position, you would have either your net defined benefit obligation that will show under non-current liability. Now, this net defined benefit obligation is usually the net. This fair value now, we usually pick the net. If the obligation, if it is higher than the plan assets, we call this net defined benefit obligation, or we can simply call it a deficit. It is truly a deficit when your obligation is higher. But if it is the other way around, that will show under non-current assets, where the fair value of plan assets is higher, that will be a net defined benefit asset. Or you can simply call it a surplus. It shows under non-current assets. It shows under non-current assets. So this is how you prepare your statement. This is what goes into your statements. Okay, let me not go beyond this. There's still, this is everything for defined benefit plan. There's just one more principle I need to tell you, asset ceiling, but I'll just leave this one till next class on Saturday, where you guys will be more active. So what we'll do on Saturday is we'll just solve 3 questions on this. Then I would also explain asset ceiling, then solve one question, then probably look at some past questions, and I'll also review your assignments on IFRS 2. We just use that to wrap up everything so far. Then Tuesday or Wednesday next week, we'll start financial instruments. Then after financial instruments, we'll move to income tax. I think I mentioned income tax. Yeah, I think income tax. Okay, so do you have any questions, please? All right, let's have a wonderful night. Thank you very much. See you in the class. Bye.
Thank you, sir. Good night.
Good night, sir.